this topic, SPACs, I'll be completely honest, I didn't know what a SPAC was until I think Chris was one that told me what it was back in the end of last year. I didn't think anything of it. And then I started to research it on like YouTube and Google, and things kept popping up on my YouTube feed. So I'd watch it and I was like, holy crap, okay. And then it seemed like everybody else already knew about it. So back in January, February, I was like, you know what? I know there's a lot of people that want to learn about it, but for me, I like listening to people that actually know what they're talking about, that have experience in this. So about a month ago, I reached out to Chris and Tracy and Adam and Shaan, because I think all four of them have different perspectives on what a SPAC is and how it is currently and what's going to happen with it moving forward. So, and I could tell by when I posted this on, I think it was LinkedIn, the amount of people that expressed interest in it, and even just from the attendance here. So we're gonna go. I'll moderate the panel, and I have some questions that I'm going to ask the panelists. But at the end, there will be a Q&A side. So if you have questions, feel free to either message them to me in the chat. Yeah, or just wait till the panelists are done. So with that being said, I'm going to have each of the panelists introduce themselves. And I'm going to go based on what's in front of my screen here. Tracy, you're first.
Great, thanks, Benny. So I'm Tracy Harrison, an Audit and Assurance Managing Director here at Deloitte & Touche. I lead our Chicago Emerging Growth Company practice. And so those are companies in a variety of industries that are focused on growth, various stages. And, obviously the SPAC is getting a big news press recently, but really most of our companies, I would say, are actually probably looking for either an IPO or some kind of merger, or maybe even a private equity transaction. So SPACs is new to them as well. And so they've gotten great momentum in the marketplace, both from an investment banker side, as well as just companies that are interested in that exit strategy. So really happy to be here today and just talk about some of those special challenges, especially as it relates to financial reporting and corporate governance. I've been involved in a number of transactions, both companies here in the Chicago marketplace as well as outside. And so look forward to sharing some experiences that we've had.
Thanks, Tracy. Adam, you're next.
Hey, everybody. Thanks for having me, Benny. I'm Adam Spector, partner in our DLA Piper's corporate and M&A group. General premise of what I do is represent businesses and entrepreneurs as they grow and scale their businesses. And in all industries and verticals, one of the interesting developments, and SPACs have been around for quite some time. They've just only recently kind of taken off and proliferated. But emerging companies and businesses that we represent now have this additional opportunity to raise capital in a really real way, and we'll talk about some of those opportunities today. But it's been a really eye-opening experience for me, at least, to see this new avenue of capital, and frankly, the ease of process and valuation that some of these companies are getting at this stage. So look forward to talking with everybody today.
Thanks, Adam. Chris?
Thanks, Benny. And so again, Chris Jeffery, and just to be clear, not a real pirate. So I'm kind of going for like a sort of a Nick Fury kind of a look, or Nick Fury, Snake Pilson kind of thing. But no, in all seriousness, I had a little bit of eye surgery, so that's the reason for the patch. Anyway, I am a partner at Baker Tilly. I've been with the firm for just about 14 years, but have been doing work in internal audit, internal controls, external audit for about 20 years or so. So within my practice at Baker Tilly, we focus on, like I say, kind of all things internal controls, operational and financial internal audit, enterprise risk management, IT audit, cybersecurity, and then we do a lot of compliance work when it comes to things like Sarbanes-Oxley compliance. So that's kind of where the SPACs come in. So we've been working with a lot of companies that go public, and a lot of companies that go public via SPAC on things like IPO readiness and Sarbanes-Oxley compliance. So happy to be here and share my experiences with you. Just to give you a little bit of background on Baker Tilly. So we focus on clients that are pre-revenue all the way up to some of the Fortune 1000. Work also with a lot of large not-for-profit and private companies, and our clients span not just the U.S. but also the globe. So, like I say, Happy to be here with you and looking forward to the discussion.
Perfect. Thank you. And finally, Shaan.
Thanks for having me, Benny. Shaan Kapoor. I'm a partner at GreenCap Advisors, which is a firm that I founded that's focused on providing advisory and consulting services to emerging cannabis businesses and entrepreneurs, kind of helping guide them through kind of the ever-changing landscape in the cannabis industry, all the way from real estate and licensing to, ultimately working with entrepreneurs as they get ready for a, potential sale and potential exit. Prior to this, I came from the cannabis industry the last 2 years. I was a director of principal investments at Green Thumb Industries here in Chicago. And prior to that, spent about 12 years in investment banking in M&A. And looking forward to the discussion. It's definitely a hot and interesting topic kind of across all industries right now. So.
Awesome. Thanks, Shaan. And one of the main reasons I've known Shaan for we're just talking about almost 20 years, but one of the things that I wanted him to talk about is SPACs, and as it relates to cannabis specifically, because there is so much going on right now in it. And I thought it'd be good, since most of the people on here are not from are not in the cannabis industry, I thought it'd be good to get his perspective so we can all kind of learn the different perspectives of it. So with that being said, we'll get started. So I'm going to start with Adam. Adam, what the heck is a SPAC and how does it work?
Sure. So, a SPAC, SPAC stands for Special Purpose Acquisition Company. It's essentially a blank check company that has gone through the registration process, the IPO process with the SEC, to become a public company. But it has no objective other than to find a company to merge with or combine with in some other transactional way. And so by going public, it raises a bunch of money that gets put into a trust account held by the SPAC. And that money is essentially used to fund the transaction. What's really interesting about SPACs is that the shareholders who invest by purchasing SPAC IPO shares have the ability to get out of their investment upon an announcement by the management team of what company they are looking to acquire, essentially. And so there's a redemption rate, which creates a bit of uncertainty for target companies going through the process. And we can talk if people are interested later, but typically you would pair a SPAC transaction with a PIPE offering, private investment in public equity. And that kind of securities offering alongside the SPAC transaction will raise additional capital for the SPAC to deliver at closing to offset potentially any redemptions that are made by shareholders. And I mentioned the management team. The SPAC is run by a management team of hopefully fairly sophisticated, experienced people with good reputations in the industry that they're targeting, or in transactions or private equity, something, because that's really all the SPAC has, right? They've got money and a management team. And if they're going to sell themselves to the public to hopefully get enough investment to raise enough cash to do this, they've got to have a management team in place that is trusted and can get it done. SPACs have different focuses. Some are generalist and some are very specific in what industry or what type of business they can pursue. What did I want to say? And then the last thing I think is, I'll mention now, SPACs are a great alternative for businesses that aren't ripe for private equity at this point, or private equity acquisition, whether it's based on size of company, cash flow, or any other aspect that may not be as attractive to a traditional private equity investor. And then finally, I told you that was the last thing I was going to say, but one more thing. And something that I didn't fully appreciate until I started really looking into this and working on SPAC transactions, which is in most cases, the SPAC does not control the company post-closing. The shareholders of the target company continue to own a majority of the overall combined pool of shares post-SPAC transaction. Somewhat counterintuitive, but very interesting.
Can you elaborate on that?
Yeah. So for example, you have so let me give you, let me clarify. You've got a shareholder base at the target company. And as typically these SPAC transactions are mergers. So when the SPAC public company will form a subsidiary, and that subsidiary will merge with the target company, and they smash together at the closing of the transaction, and you've got a pool of shareholders now that are a mix of target company shareholders and SPAC IPO shareholders. Typically, when you think of a merger transaction or some other acquisition, the acquirer, in this case, which would be the SPAC, would own and control the target company that it's buying. In this case, it's the opposite, where the shareholders of the target company will continue to own a majority of the overall pool of shares up at the combined company level. So in one that I'm working on right now, for example, the target company's shareholders will own 60 or 70% of the overall number of shares of the combined company post-closing. And so they'll continue to control.
Got it. Thank you. I needed that clarification, so I don't know if anybody else did, so thanks.
I'm just going to add something a little, like to add to what Adam was saying as well, Benny. I mean, an interesting part of SPACs as well is usually the promoters, so the executives that put the SPAC together, kind of like traditional private equity. They usually end up with almost 20% of the post de-SPAC company that's actually going public. So that's kind of the other interesting part of it too, is that basically for promoting the SPAC, finding the target, kind of doing all the work, they are basically getting 20% of the final kind of company as well.
Yeah. So, and by the way, that point is kind of, this is not, so two things. One, SPAC transactions are essentially a capital raise and not an acquisition. That people think about it as an acquisition, but it's essentially a capital raise, to Shaan's point. And that said, further to Shaan's point, it's not a cheap way to raise capital, but it's a very effective way.
Got it. So what does the SPAC market look like right now, Adam?
So yeah, so the SPAC market is booming. It's all the rage in the M&A world right now, and even in the kind of emerging company world. I think we're seeing a lot of companies that would not be able to go through the traditional IPO process because they aren't mature enough at this stage, see this as an opportunity to go public earlier and to raise a substantial amount of capital very quickly. For example, actually, I'll tell you give you some stats in a second. One SPAC transaction that we're currently working on, the target company made $14 million top line revenue last year. And the SPAC acquirer has valued the company at $1.5 billion.
Wow.
So the valuations are insane. And I'll give you some stats right now that will kind of will help you understand the competitive nature of this market. Because remember, and one thing I forgot to mention is each of these SPACs has somewhere between 24 and 36 months to find an acquisition target. By its corporate governance documents, it has to complete a transaction in that time frame, unless the shareholders agree to extend it. So the clock starts ticking once they've gone public, and they're on the prowl to get a deal done. And once I tell you how many SPACs are running around out there right now, you'll see why it's fairly competitive. So to give you a little perspective, in 2019, there were 59 SPAC IPOs that raised in the aggregate $12 billion. In 2020, most of which was in the second half of 2020 because COVID threw the first half essentially down the drain, there were 246 SPAC IPOs that raised over $75 billion. So 246 in 2019. In the first 4 months of 2021, there have been over 300 IPOs for SPACs. So in total, there are about 560 SPACs running around out there, 130 of which have deals pending. So there's 430 SPACs that are hungry, waiting to acquire a company. So needless to say, the investment bankers and lawyers doing these deals are, nonstop at this point. That being said, there has been a little bit of a slowdown recently, given the market volatility. I think investors have decided not to kind of do what they were doing in January, February, and March, which was invest, no questions asked, like just do it. This is great. They're now slowing down. They see some volatility. They see a little bit more risk, and they're doing a little bit more kind of due diligence, which is what I would consider the normal way to do it. So we've seen some, the announcements in April have kind of fallen as compared to the first 3 months of the year, but nonetheless, the market is still booming, and there is a lot of cash to be spent and a lot of target companies that are ripe for a transaction.
Awesome. So just real quick, if you said 24 to 36 months, right?
Correct.
So what happens if they don't find a target company to get the deal done in 24 to 36 months?
Yeah, if they don't find a company and the shareholders say, you know what, forget it, you didn't get it done, we're not going to allow you to extend, the money just gets returned to the shareholders.
Got it. Cool.
Yeah.
Thanks, Adam. Now I have a couple questions, and it's going to be for both Chris and Tracy, because they could both talk about it from a public accounting perspective, but from different perspectives. So the first question I have is, from an accounting and auditing point of view, what are the biggest differences between a traditional IPO and going public via SPAC?
And Benny, I can start with this one. And Adam talked a lot about what the differences are from kind of a capital raise and legal standpoint. And so what I'll talk about is just some of the differences as we see them from more of a like I say, an accountant, as Benny asked, an accounting and auditing standpoint. So if you think about a traditional IPO, so a company has a plan to go public, they've got a plan to do an IPO. So they may spend, several months, if not years, preparing for that. So they get a team in place, they, prepare their processes, they get their financial reporting squared away, they hire an investment banker, they hire an attorney, they complete their S1 filings, et cetera, and really kind of get everything sort of lined up. In a SPAC, on the other hand, as Adam, mentioned, a lot of the companies that are out there aren't necessarily looking to go public, or that's not really part of their plan, but they may be approached by the SPAC. So the SPAC sponsors identify a target, they work with the target company, they agree on the deal, they obtain shareholder approval, they file a proxy with the SEC, they close the deal, and all of a sudden that company is public. And so they may go public in a matter of a couple of months at most. In some cases, I think it happens sometimes even quicker than that. So that's really kind of the difference. So from a target company standpoint, they sort of become public almost overnight versus something that they plan for, like I say, months or maybe even years. So that's what I see. Tracy, I don't know if you've got anything to add to that.
Yeah, no, Chris, I think that's a really good summary. The other thing to think about is a little bit, as Adam talked about, obviously this is somewhat of a merger, and at the end, the operating company management is normally the, continuing management. You're also inheriting accounting and considerations that existed in the SPAC. And so, along the lines of just getting your own accounting and reporting, finance and accounting needs to also prepare to be able to address some of those accounting issues that the SPAC may have as well, to kind of continue that process. And so I think that's the big surprise, because you can know your company really well and understand the controls that you have, but suddenly, you're creating your own controls, as well as kind of evaluating this new entity that you're part of.
Got it. So from a timing standpoint, Chris, I think you mentioned like 6 to 7 months, but I just want to make sure I heard you properly. And both of you could answer on this. So how long, on average, how long does it take for a company to go through the traditional IPO process? And Chris, you mentioned kind of like overnight for SPACs, but I'm guessing it's not literally overnight. But like, how long would it take for a SPAC versus an IPO?
Because I don't know, it kind of depends. Every company is a little bit different. Like, so we see like companies on the traditional IPO path that maybe have that as their exit plan, especially in some of these popular industries, planning a year in advance, right? You can get things done in a very short time frame if you want to, but if you're in a better spot, like you would be able to plan ahead so the workload doesn't all fall into a same period. A typical timeline, right, would be 60 days to get to a filing. I mean, that's the typical IPO timeline that a banker is going to give you. But normally there's a lot of things that have happened in the front end of that to get to there. Whereas in a SPAC, you may not have necessarily even considered or thought about it. And at times the SPACs will come before they have money. Sometimes they will come when they have the money. And so like we've seen some that have been, forced to be within 45 days of an announcement to try to get to be, compliant.
Yeah, and I would absolutely agree with that. I mean, we typically recommend if a company is planning for an IPO process, we typically recommend, a year or so is about an ideal amount of time, because at that point you can really again get there's a lot of things to think about. You got to think about financial reporting, you've got to think about your team, you've got to think about your internal controls, you've got to think about making sure that you've adopted all the new accounting rules, especially as related to a public company versus a private company. So we really recommend a year in a traditional IPO process. But as Tracy mentioned, when you're working with a SPAC, or if you get approached by a SPAC, you might not have that kind of time. And so we've seen companies go through the process very, very quickly. But again, it's more challenging on the management team to do that. Challenging, more time consuming, frankly, more expensive.
Got it. And I'm just taking a look at like the people that are on the Zoom right now, and I think the majority, I would say easily, is people that are in the CFO role, and definitely some founders, and definitely people from venture capital, as well as some founders and CEOs. So as I just wanted to make sure I get that clarified from you guys. So what are some of the key work streams, both pre and post SPAC transactions?
Well, I can start here. And so what I would say the key work streams are, pre, and I guess I'm talking about things from the target company's perspective. But I think the key things to be thinking about, again, would be a company's internal controls, and what do those internal controls look like, and really understanding what the company is going to need to do, and how they're going to need to comply with the Sarbanes-Oxley Act. So there's a lot of different nuances to that. And does the company need to be compliant? Will the company be an emerging growth company? Will the company need to be compliant with SOX 404 Section A or Section B? They're both a little bit different. A is a little bit less onerous, and B is much more onerous. So you've got to understand how the company, which level of Sarbanes-Oxley it will need to comply with, and what the company will ultimately need to do. There's an element of financial reporting in there, and making sure that the company it has the right is accounting for its transactions correctly. And then even just some of the basic things, like does the company have a financial reporting team in place? Does it have an IT system in place that can support a public company? Those kinds of things. So that's what I would say would be sort of the key work streams pre, anyway.
Yeah, Chris, I think those are definitely key. Maybe just to add a couple other things to be thinking about. Tax is also a very big consideration. Many of these companies that are being targeted are actually LLCs, and they need to be an Inc. to be a public company. And so there's some tax considerations both for the founders as well as the company and how to do that. And then maybe to also put a little bit of a plug in for Adam. Corporate governance is really important. And so we've seen a lot of companies need to spend time with creating, charters and just like, documentation around how that's going to work from an overall perspective, getting your committees together as well. Adam, I don't know, you probably have some more details on how to weave that in better.
Yeah, no, and I'll just say, in addition to corporate governance, capitalization, making sure, especially for these younger emerging growth type companies, making sure your cap table is up to snuff and documented accurately is critical. And I'll give the plug right back to the accounting folks. It's critical, it's required that any company that goes through this process is kind of what we would call public company ready. And part of that is having audited financials. And that's a process in and of itself. If if the company is doing it for the first time to get ready for this transaction. So anyways.
Cool. Thank you. And what about after? So what are some of the leading practices as it relates to preparing for the post-SPAC transaction?
You want to take that one, Tracy?
Yeah, maybe I can start off. A lot of those are very similar, right? You want to make sure you have a really good, strong finance and accounting team that's prepared for public reporting. The SPAC, it's sometimes depending on when you actually go public or have the transaction complete, you may only have 45 days. We've seen that very commonly to get to your first Q. So that's really important post consideration. Obviously, also to your internal processes and controls, we've mentioned that as well. Maybe the other things to also be thinking about is cyber. All of a sudden, when you become a public company, you're responsible for cyber reporting under the SEC requirements. And so just understanding, how you're going to get knowledge and awareness around attacks and how you're going to be evaluating and reporting those and considering them in your filings.
Chris,
Yeah,
you have anything to add to that?
Well, I was just gonna, I think what we're really trying to say is once the company has complete, or once the company has effectively de-SPAC'd and it's gone public, and now all of a sudden it's listed, and and it sort of automatically becomes an SEC registrant. What we're really saying is now the company needs to act like a public company. It needs to make sure it's able to report underneath SEC type reporting standards. It needs to make sure it's got a management team in place that has the knowledge to be able to handle all of those kinds of things. And it's much different than the requirements of a private company. So really, I think that's what that's really what we're trying to drive home is that all of a sudden the company's public, and it really needs to be able to act like a public company sort of right away.
Got it. Thank you.